Meta Platform stock is down nearly 13% from its 52-week high, and on today's episode, I want to explain where it could be in the next 5 years. Meta Platform is the parent company of Facebook, Instagram, WhatsApp, and Reality Labs. With a global user base exceeding 3.4 billion daily users, Meta dominates the social media landscape through network effects, advertising reach, and data-driven AI capabilities. Its advertising business makes up 98% of total revenue, powered by user engagement across its platforms, and Meta's moat stems from its unmatched scale of data and AI integration that enhances both ad targeting and users' experience. However, Meta faces considerable risk. Things like rising regulatory scrutinies, intensifying competition, and massive spending on its metaverse visions via Reality Labs. Throughout the episode, we will discuss recent earnings, the bull and bear case, and so much more. Meta's Q1 2025 marked a strong start to the year, with the company beating Wall Street expectations and posting double-digit growth. Key highlights from the most recent earnings include the following. First, revenue. Meta generated $42.3 billion, up 16% year over year, and this growth was driven by a recovery in advertising demand and higher monetization per users. Next, we have profitability, where net income came at $16.6 billion for the quarter, a 35% year over year jump, with diluted earnings per share of $6.43, up 37% year over year. These earnings far surpassed analyst estimates. Next, we have segment performance. Meta's core family of apps segment, which includes Facebook, Instagram, WhatsApp, etc., continues to carry the business, accounting for 99% of Q1 revenue at $41.9 billion, and an operating income of $21.77 billion, which is implying a hefty 52% operating margins in this segment. In contrast, though, the Reality Labs segment remains a money pit, with revenue just short of a little bit over $400 million, down 6% year over year, while its operating losses deepened to $4.2 billion. That is insane. Now let's understand the overall market. First, if we look at industry trends and competitor, Meta is a leader in the $1 trillion plus global digital advertising market, which digital now represents 73% of total ad spend, and Meta competes with Google, Amazon, TikTok, and Snap. In AR and VR, Meta leads in market share, 80% with Quest headsets, but the sector remains niche. Apple's entry with Vision Pros raises the stakes. Now let's look at the bull case for Meta Platforms. First, it's just a resilient advertising growth and monetization upside. Meta's core advertising business is not only enormous, but still growing healthy. Ad revenue, as previously mentioned, grew 16% year over year, showing that the underlying demand for Meta's ad platform. Now, the bull view is that Meta can continue to deliver solid growth, perhaps high single to double-digit percentage for the next years to come. And the key drivers include increased monetization of newer formats. Then we obviously have AI-powered innovation and efficiencies. Meta's aggressive investment in AI are starting to bear fruit in ways that strengthen the business. By deploying advanced AI models, Meta has improved its ad targeting and delivery. For example, a new AI recommendation model raised ad conversion rates by 5% on Reels, effectively making ads more effective for advertisers, which in theory encourages them to spend more. Now we have metaverse optionality, which is a long-term upside. While the metaverse initiative is viewed as skeptically by many, bulls argue that if it succeeds, the payoff could be enormous. Meta is positioning itself to lead the next growth of computing, which could be augmented reality and virtual reality, which could create entirely new markets. If products like the Quest handset or the Ray-Ban AI glasses ever gain mass adoption, Meta could be extraordinarily well placed to dominate that ecosystem. And we also have the unmatched scale and ecosystem synergies. Meta's sheer scale of users and engagement gives it a strategic advantage that bulls believe will persist. With close to 4 billion people using its apps each month, Meta can cross-promote new features or apps like it did with Reels and Thread and instantly reach massive audience, a capability smaller competitors lack. Now, if we look at the bear cases, there is a lot. For all its strength, Meta also faces a lot of risks that could undermine its growth or valuation. The bear case for Meta platforms focus on first, regulatory and legal threats. Meta is under unparalleled scrutiny from regulators globally, which bears argue can materially disrupt its business. In the US, the Federal Trade Commission has an antitrust going on right now and seeks to potentially break up Meta. Such an outcome would shatter the synergies Meta enjoys across its family of apps and could diminish the overall value. Next, competitive erosion of engagement due to competition. Meta's dominance in social media is not guaranteed to persist if users' preference shift. If TikTok continues to gain traction, especially if it isn't banned in markets like the United States, it could capture an increasing share of ad budget. And bears point out that Facebook usage among teens and young adults have been declining for years. And finally, we have market saturation and slowing growth. Meta is so large that maintaining high growth rates becomes extremely difficult, a classic law of large numbers problem. In its most developed markets like US, Canada, and Europe, Facebook's user growth is flat and ad load is already quite high. There's only so many ads you can show per users without harming experiences. Thus, revenue growth in those markets must come from higher pricing, which is tied to advertising demand and efficiency. Now, one key metric for investors. Meta has many moving parts, but perhaps the single most important metric for investors to watch in the coming years is Meta's operating profitability in its core family of apps relative to the drag from Reality Labs. In essence, can Meta sustain its robust core margins while maintaining to fund its metaverse ambition? This balance will likely determine Meta's financial trajectory and investor sentiment, especially since last quarter, roughly 1/5 of core profits were wiped out by Reality Labs. Now, my 5-year prediction. Based on current fundamentals, Meta Platforms is likely to be significantly larger in 5 years, driven by steady expansion in digital advertising and the incremental contribution of AI-driven products. Meta, in 2030, if executed well, could generate roughly $275 billion in revenue, with net income of $90 plus billion and earnings per share of roughly $40. Assuming a 20x PE ratio, Meta could trade at around $800 per share by 2030. A more bullish 25 PE ratio could push the stock past $1,000. Risk remains, but Meta's AI, ads, and platform scale give it strong upside with disciplined execution. Ready to discover more promising investments opportunities? Visit fool.com/invest to get the top 10 best stocks to buy now. That's it for today. If you found this insight valuable, hit the like button, subscribe for more, and help make our community smarter by sharing your thoughts in the comments below. Stay foolish, and we'll see you next time.